In this video, we'll talk about how legendary investors such as Warren Buffett pick stocks. So how do you pick stocks to invest in? If you want to get good at anything, I found the best way is to find somebody who has an incredible long-term track record and do what they do and do it even better. Now, there's a mindset of swinging for the fences when people are lacking in their life financially. And the ironic thing about taking big risks, where the downside is losing everything, is that it rarely produces wealth. In fact, it can create a lot of setbacks and emotional distress, such as the $70,000 I lost in 6 months when I tried my hand at day trading. Since following the Warren Buffett system, my returns have skyrocketed. 2 years ago, my stock market portfolio returned 30.56%. Last year, 25.15%, and this year, 29.62%. And since I'm in the asset protection business and I have a multi-million-dollar portfolio, it's all sitting in an international asset protection trust in a safe international brokerage house. So it's protected from lawsuits and so many of the other things that can happen. Now, how did I go from losing $70,000 5 years earlier to more than doubling my money in a few years? Well, following the system that we're about to talk about. So we're going to cover Warren Buffett's formula, and I want you to write this down. The biggest tip is don't look at the price first, look at the earnings first. Again, don't look at the price of a stock first, look at the earnings per share of the company, and then determine how much you're willing to pay for those earnings. Then we're going to switch to the iPad, and we're going to actually look closely at two stocks, one that went up and one that went down, and how the formula applies in the real world. Hi, I'm the business guy, the CEO of Lawyers Limited, the nation's largest firm that sets up companies and trusts to protect people's assets from lawsuits. And if you appreciate this step-by-step formula on how to pick stock, please click the like button below so YouTube promotes this video. Thank you so much. And if you're new here or just need a friend, you can click the subscribe button below so that when more videos come out like this one, you'll be up to date right away. The next thing to look at is if those earnings are growing and expected to continue to grow, like Apple, Amazon, Google. Then look to see if that company has a moat, like a moat around a castle, so it's hard to compete with. More about that later. Now, the very wealthy actually took a lot less risk than you may think. They think in terms of asymmetric risk versus reward. The opposite mindset of risking it all for gains is just one of totally giving up and not trying or attempting to grow. There's a middle ground of methodically measuring and making pragmatic investment decisions. Now, encompassing this entire video is the blanket statement that none of this is investment advice, and seek a licensed investment advisor. We do have licensed attorneys on staff who you can call right now to protect your assets from lawsuits. Now, there's an old saying that covers a lot of the things we're talking about here. It's the story of AESOP'S FABLE. Warren Buffett has this to say about AESOP'S FABLE. The formula for value investing was handed down from 600 BC by a guy named AESOP. A bird in the hand is worth two in the bush. You've heard of it. Investing is about laying out a bird now to get two or more out of the bush. The keys are only to look at the bushes you like and identify how long it will take to get them out. Another idea from Warren Buffett is this fable. Leaving aside tax factors, he says, the formula we use for evaluating stocks and business is identical. Indeed, the formula for valuing all assets that are purchased for financial gain has been unchanged since it was first laid out by a very smart man in about 600 BC. Although he was not smart enough to know it was 600 BC. The oracle was AESOP, and his enduring, though somewhat incomplete investment insight was a bird in the hand is worth two in the bush. To flush out this principle, we must answer three sets of questions. Number one, the first set of questions are about certainty. How certain are you that there are indeed birds in the bush? Is the investment one we understand? Is it within our circle of competence? Does the business possess a moat that is enduring? In other words, is it easy or difficult to compete with? With cryptocurrency, for example, there's virtually no moat. The potential competition is almost infinite. With Amazon, you just try to snap your fingers and have 110 fulfillment centers nationally and 185 globally, so you can deliver millions of products overnight or in some cases the same day. Just try to compete with that. Number 2, time and amount. When will they emerge and how many will there be? What is the total amount of cash flow, owner's earnings, the business will produce from now until Judgment Day? And when can you expect to receive that cash flow? And number 3, as a comparison, what is the risk-free interest rate, which we consider to be the yield on long-term U.S. bonds? Can you go down to the bank and open up a savings account that pays you 12% per year? It might make the bank a more attractive place to put your money in that case. Or will they only pay you a fraction of a percent per year? So if you can answer those 3 questions, you will know the maximum value of the bush and the maximum number of birds. You now possess the information that should help you decide what should be offered for it. And of course, don't literally think birds, think dollars. AESOP'S investment axiom, thus expanded and converted into dollars, is immutable. It applies to outlays for real estate, farms, oil, royalties, bonds, stocks, and manufacturing plants. And neither the advent of the steam engine, the harnessing of electricity, nor the creation of the automobile has changed this formula one iota, nor does the internet. Just insert the correct numbers and you can rank the attractiveness of all possible uses of capital through the universe. Now, speculation, in which the focus is not on what the asset will produce, but rather on what the next fellow will pay for it, is neither illegal, immoral, nor un-American. But is not a game which Charlie and I wish to play, he says. We bring nothing to the party, so why should we expect to take anything home? Let's take a look at this in the real world, and we'll look at 2 stocks, Apple and GE, and really pay attention here, because when you're sitting alone deciding where to invest your money, you'll be doing a lot of what I'm about ready to show you here. Now, a lot of what we're going to cover here is covered by these next 2 quotes. The first one is from famed investor Peter Lynch. What the stock price does today, tomorrow, or next week is only a distraction. Follow the earnings, assuming the company has earnings. Sooner or later, earnings make or break a stock market investment, by Peter Lynch. Next is a very famous quote by Warren Buffett's mentor, Benjamin Graham. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. Now let's go ahead and take a look at Apple. In January of 2006, the average price for Apple was $2.53. Its earnings that year were 8 cents. So that's a return on the price of 3.16%. 1-year CDs during that time were paying 3.64%. So if you look at 3.64% and 3.16%, where do you think you want to put your money? So in 15 years, saying the interest rate stayed the same and you kept putting your money into 1-year CDs, in 15 years you'd have $3.95. That's what your 253 would turn into. Okay, now let's take a look at the earnings of Apple. See what happened to the earnings over this time. You can see the earnings per share here, and this is what we need to look at. This is what we need to focus on, not the price, the earnings per share, then determine what you're willing to pay for those earnings. Okay, take a look at the earnings per share of Apple. You can see the trend here. See, watch the trend. There's the trend for the earnings. So if the average price, like we talked about for 2006, was $2.53, here were the earnings per share. The difference here is that the earnings per share increased over time. So as the earnings increase over time, the price of the stock will naturally increase over time. So your $2.53 turned into $138.61 in 15 years, as opposed to only $3.95 if you had them in 1-year CDs paying 3.64%. So that's what we want to take a look at. Are the earnings of the company growing over time? And we can do a projection if we think the earnings will continue on that trajectory. So let's see if the axiom is true that the price of a stock follows the earnings. You can see these are the earnings per share. Look what happened to the price here. It followed a similar trajectory. So let's go ahead and take a look at what happened to GE. Here is the average price of GE during 2006. Here were the earnings per share, a return of 5.82%. Now the question is, if the 1-year CD was paying 3.64%, in 15 years you'd have $3.95. Would we rather put our money in the 1-year CD, or would we rather put it in GE? Well, it looks like GE has a better return. Let's go ahead and take a look at Apple again. Okay, Apple had a return of 3.16% compared to 3.64% for a one-year CD. So one might think it might be better to put the money into the CD, right? But the problem is, if this interest rate stays the same, these earnings here keep increasing. That's the big difference. That's why we look at earnings per share and its trajectory and not just the price, okay? So let's go ahead and take a look at what happened with GE earnings over this time. Remember, price follows earnings. So that's the reason you should look at the earnings and then determine the price you're willing to pay for those earnings compared to all other alternatives, okay? So let's take a look at what happened to the earnings of GE from 2006. You can see they lost money, they lost a lot of money, and see what happens. So from 2006 to 2020, the biggest earning year was 2006 and 2007. And then it just went downhill after that. Look what happened to that company. And you can take a look at the trajectory of the earnings of GE. Now, what should happen to the price of GE? And of course, this is adjusted for splits in both cases. Let's go ahead and take a look. You think you may want to invest in GE instead of the CD, but let's take a look at what happened to your money. In 2006, the average price of a share of GE, split adjusted, was $274.83. In 2021, $102.69. You would have been better off in the CD, or much better yet, picking a better company to invest in, okay? So let's go ahead and take a look at the price. Aha, right? Look at the trajectory. Stock price follows earnings. So keep your eye on the earnings and then determine what you want to pay. Just because a stock has a trajectory that looks like this doesn't mean it's a good deal. Take a look at the earnings, what the earnings could be worth in the future, and if those earnings are worth the price you want to pay compared to other alternatives. So where did I get these numbers? I just Googled Apple earnings per share and I got these figures. You can do the same when it's time to pick a stock. Now, just like we talked about, the best way to be successful is to find out somebody who's been successful and follow what they do. Now, it's a similar philosophy when picking stock. It's a lot easier and a lot better to look at a stock's track record over time. I mean, since 1913, there have been 2,000 car companies. 2,000. Now there are only 3. How do you know which of the 2,000 are going to win unless you have a track record of increasing earnings? So back in the dot-com era, it's too hard to pick which of the thousands of companies were going to turn into Amazon unless you have a track record of earnings. So the key thing that Warren Buffett will do is he'll wait to buy the company until it has a track record of earnings that he can look back upon. That's the key thing. Now, and this is true in recent times, the line separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates reality like large doses of effortless money. After a heady experience of that kind, normally sensible people drift into behavior akin to that of Cinderella at the ball. They know that overstaying the festivities, continuing to speculate in companies that have gigantic valuations relative to the cash they are likely to generate in the future, will eventually bring on pumpkins and mice. But they nevertheless hate to miss a single minute of what has been a hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. And there's a problem, though. They are dancing in a room where the clocks have no hands. And as you can see from Buffett, there's a lot of wisdom buried in the quote, "A bird in the hand is worth 2 in the bush." So think in terms of the money that you outlay, how long, at what quantities, and what time frame that you get your investment and more back, and how it compares with the other options, including prevailing interest rates. So thinking in terms of cash flow for that return, earnings per share, rather than what a speculator will pay you for what you purchased, is an enduring philosophy. This philosophy, as Buffett says, drives all of his investment decisions. Please click like, subscribe, and share this video on Facebook. Thanks for watching. This is The Business Guy.